Thanks for the introductions. It's great to be here. I actually crossed paths in the air with President Trump because I flew in from London just a few days ago. So it's good to be here in New York, sit down with you and talk a little bit about kind of the global perspectives on M&A and the things we're looking forward to, what we're worried about, what we're optimistic about. But I thought we'd kick it off with a poll question, if we could bring that up, which I think in these uncertain times, the poll question asks, what kind of things should we be investing in? What are our safest bets? If you can bring it up, if you can pull out your phones, go to Bloomberg Invest app and put in your poll answers, that would be fantastic. The idea being that in these times, everyone wants to know what's a safe asset. And Nadine, I know that you grew up or you spent a lot of time in Canada. You, in fact, went to school with Justin Trudeau, so I figured Canadian cannabis stocks is an area of expertise you could fill us in on. Vintage cars. Bill is a collector of vintage cars when he's not advising clients on M&A, IPOs, and capital structure. So I figured you could provide us some good feedback on that.
Oh, I'm losing.
And then, of course, artwork, always a good area to invest in. I think shown by the $450 million Da Vinci bought by the Saudi prince, also an area to look into along the more traditional oil and infrastructure areas. So let's see, infrastructure assets, okay, that's very popular. Artwork, okay, no big fans, that's a little bit disappointing. But hey, vintage cars, just so you know, there was a record 1962 Ferrari 250 GTO that sold for $48 million in 2018. Bill, was that your car?
No, it wasn't. No, my cars are the depreciating trend there, so I think you folks are right at the 4%.
Got it. Good to see. Okay, infrastructure assets, which is also an area we talked about beforehand. Why, in this age of uncertainty, why is capital flowing to infrastructure assets? So I'd love to hear what are the drivers, what's attracting that capital, and who are the people behind the investments?
Yeah, that's really a new asset class that's drawn a lot of excitement, and it's gone beyond the way I think we've traditionally defined it in the U.S. as being bridges, roads, and tunnels. Where municipalities and states, because of the lack of funding, have gone to these P3 projects. And that historically was what I think a lot of folks talked about when they talked about infrastructure. So now, recently, we're really seeing this as what I'll refer to as a horizontal sector. So it's not just the traditional municipality infrastructure, but it's oil and gas, telecommunications, power and utilities, cell towers. I mean, I could keep going. And there's just been a tremendous amount of fundraising associated. Right now, there's about $150 billion of assets under management. Last quarter, another $20 billion has been raised. And it's an interesting asset class. The traditional P3 type investments in the bridges, roads, and tunnels, and toll roads, and these sorts of things, those were returns that are relatively low, 7 or 8%. And now, we're seeing kind of a different class where you have these, again, I'll refer to it as a horizontal sector, where the returns are much higher. They're 12 to 14%, which is attracting different investors. So for years, you saw I'll talk more from America's perspective. You saw the Canadian pension funds were always big in this. And they were always big from, let's say, the traditional P3 type investment. Tons of that stuff in Canada. They were very active in Latin America, doing these types of transactions. But now, with this new class that's come in, you're bringing in other investors, which is primarily the sovereign wealth funds, the private equity funds, because the returns are attractive, 12 to 14%, and they're not 30-year deals.
But isn't that stiff competition making the returns? I mean, it must be harder to generate those returns when people, is there risk that some of these investors, whether it's sovereign wealth funds, pension funds, will overpay?
Well, I think part of that, too, is when you look at, the opportunities that are out there, and I think, some of the, I would say the big chunk of this that's exciting is the take private. Look at a lot of these MLP, which are the master limited partnerships that are for the oil and gas sector. I mean, these are all cash deals. So it just goes to show you the amount of money that's out there. So I think, they're very attractive and the returns, are attractive. They're not quite at the private equity, level, but they tend to be a little more longer term with more predictable cash flow. So I think it's a nice premium.
Yeah. Speaking of private equity, they're sitting on something like 1.4 trillion in dry powder, and we've seen a lot of take privates both in the U.S. and Europe. But we've also seen stiff competition with strategics when they're trying to buy assets. What do you think when you're talking to private equity clients? What do they need to keep in mind when they're looking for targets, and where are they struggling to deploy all that capital?
So, I mean, I think private equity, they're thesis investors in many respects. I think the thesis has always been around value creation. But what they're thinking about now is, how do I invest in a platform that perhaps is going to cost me a little bit more, but then have a consolidation or a roll-up strategy around that, so it sort of takes that price point and premium down a little bit. So it's a much longer duration of outcome, I think. So the short flip exits are not necessarily there. I think they're investing in platforms, they're doing roll-ups and consolidations, they're looking for longer term horizons to create value, and then they're looking at exits that sort of justify those premiums on the way in.
Right. Well, I think the private equity market now is obviously very, very exciting. There's a tremendous amount of dry powder, tremendous amount of fundraising. I mean, that does not seem to ebb whatsoever. And if you look at just the number of portfolio companies that are owned by private equity, I mean, it's like tripled in the last couple of years. I mean, it was like, what, 2,000 to 4,000 not long ago. Now it's 12,000 to 14,000. And the impact that private equity is having in terms of just the numbers that are out there. And so where are all these businesses coming from? How did it go from 2,000 to 4,000 to 12,000 to 14,000? I mean, it's really, then you flip to the corporate side. It's corporate is continuing to really challenge their portfolio, which is driving a lot of these divestitures. Private equity obviously has a big appetite. As Nadine said, there's premiums being paid for good platforms, and then the idea is, all right, sure, I'll pay a premium for this great platform company, which takes a lot of strategics out, but at the same time, I'm going to, let's say, buy down after that. So yeah, I'll pay a whatever, instead of a 10 multiple, I'll pay a 12 multiple, but then I'll have this great platform, and I'll do roll-ups. Right. I'll do roll-ups at an 8 multiple. I'll make it up, 8 or 9 multiple, which effectively buys down that premium. So that's exciting too. And I'd say, the last part about private equity, a significant change over the last couple of years is the entrance into the banking market, the credit market, let's say. Not long ago, 4 or 5 years ago, probably 2/3 of the deals, if not more, were financed by the banks. Now it's been disintermediated, and now probably it's 15%. And private equity has picked up the difference on that. You talk about dry powder as it relates to investing in portfolio companies. There's a ton of dry powder related just to credit, associated with that.
Do you think regulators are growing increasingly worried about that explosion in private credit? I mean, are there risks related to that maybe the banks, have kind of gotten their hands, gotten control of since the financial crisis, that maybe the private markets aren't as tightly regulated?
Yeah, there's been a lot of discussion about sort of, is there an unequal playing field potentially between the regulatory environment faced by, financial institutions traditionally regulated, and then the private capital market and the alternative credit market that isn't regulated. There is much more of it, and it's not necessarily sort of looked at the same way. I think it's a concern, maybe is an overstatement. I think sort of awareness of the amount of private credit that's out there is certainly there. At the end of the day, they're attracting, sort of investors with, intelligence around what the risks are associated with that. Yeah. But no doubt it's on the conversation table. And we sort of talk about private equity. That's, the traditional LBO strategy. These are not, private equities as we've traditionally thought about them. They're really alternative asset managers. So they are also focused on infrastructure. They're focused on credit. They're focused on anywhere in the capital stack these days, right? So they're playing at different places. So I think they're thinking about sort of risk in their portfolios differently, perhaps. And maybe that's sort of to your question. It's how do these institutions who are alternative, asset managers really think across their entire portfolio? How do I aggregate risk differently, perhaps?
Yeah, and speaking of banking, we've also seen some really interesting deals in the FIG space, ones that kind of reflected tech disruption, that moved towards digital, whether it's JP buying WePay or Marcus Goldman buying Clarity. So Nadine, I'm curious, why do you think there is such a push from the traditional banks to get into that space, whether it's robo-advisors, asset management? Yeah,
so I think there's a couple of drivers of all of that. So one is, if you were to draw institutions and their technology, you wouldn't draw them the way that they've built over time. And so what these sort of disruptors or challenger companies are doing is saying, if I had a blank page, this is perhaps how I would solve for, not only the infrastructure that's driving sort of a consumer outcome, but equally so being much more client-centric. So that's a movement around client centricity that we're seeing in every industry, financial services included. And so they are coming with a cleaner view of what customer looks like and perhaps what technology could look like. Traditional institutions might have looked at those as challengers. I think they're equally, and frankly more so, thinking them now as collaborators. So they're acquiring new talent, new technology, and they're value creating that back by leveraging it across their institutions. So that's a very big driver. I would say a sort of an equally important driver is access to talent. So these institutions are bringing a mindset, a culture, and a talent base that might not traditionally have been sort of grown in these sort of traditional financial institutions. So the talent and sort of the capability set equation, I think, is equally important. And then in all of these cases, or at least in many of these cases, most often they're providing access to new customers that perhaps were not previously served. So it's not about sort of competitiveness around shrinking the pie, it's about growing the pie. I think Robo Advisors is a great example of that. So it was a solution to not necessarily pull assets away from traditional managers, but was actually providing a solution for assets that were blind to managers. So now we can do that cost effectively and increase, frankly, the assets that are available to invest.
How do you think the traditional banks can attract that kind of talent when there's such a draw to Silicon Valley, to tech companies? What can they do to really convince these young, smart minds to come work for the banks?
I mean, there's all sorts of statistics out there around, that Wall Street is actually hiring more data scientists than any other industry out there. And I think that, the complexity or the interesting problems is truly what attracts that sort of talent set. And so as long as we keep putting interesting problems and making that a career option for people to solve those in a way that they want to work, and I think there's a culture around how we work and sort of the image of Wall Street, I think they will find a reason to attract that talent.
Okay, so it's not as easy as just ditching the ties or
No.
wearing jeans.
Yeah, suits and jeans and wearing ties to work and sitting in beanbag chairs. It's a little bit more than that.
Yeah.
But there's, it is amazing the statistics about data science in Wall Street.
Got it. And in the FIG space, we've also seen some consolidation in the regional lenders, obviously SunTrust, BB&T. I wonder, do you think that's maybe the first domino among the larger regional banks to drop, and we will see further deals like that going forward? And why do you think they're looking for those kind of
So at every stage of the
acquisitions?
cycle, we've talked about sort of banking consolidation. There's always different drivers. But we have seen financial services deals, frankly, there's twice as many large deals, so $5 billion plus deals that have happened in this year than they did last year. Some of those are in the payment space. We've all seen the large payments transactions, but equally so, we're seeing large bank deals, and we haven't seen deals of this size. And I think that's a combination of regulatory relief that has certainly sort of made that a little bit more possible. So regional banks and the SIFI threshold has allowed them some headroom to grow, but equally so relief around M&A approvals.
Right.
And then I also think that there's a real synergy story to be told now if you think about mergers of equals, and you can get to a size and a scale that allows you to compete with the largest money center banks and create capital through synergies that'll allow you to sort of invest in the technology platform that you're absolutely going to need to have to compete with those large institutions that are putting billions of dollars in technology. And they've had a head start. So it's about sort of creating capital to invest and to create sort of institutions that can compete with markets. So the markets reacted fairly favorably to deals that show synergies, that show good combinations of good product mixes, and a good future sort of path to outcome.
Great. One advisor I was speaking to recently said when you see big banking deals, that means that there's a bubble coming. That's always the end of the cycle. I don't know if that's scientifically proven, but that was his claim. If we look at the chart that was up earlier, we've seen 5 years of growth in M&A, quite robust, and the question is how much longer can that last? I'm curious, Bill, when you're kind of talking to your clients and CEOs, what are kind of the top worries that come to mind?
Yeah. So, great question, obviously, and one that's probably on everyone's mind. And so, I would view it as there's the pessimistic view, the optimistic view, and the realistic view. And I'd say the optimistic view is that there are no imminent signs of a near-term recession. So, I think on average the likelihood of recession risk in the U.S. is about 15%. So I don't think there's any reason to suggest that would change otherwise. So that's the good news. That's optimistic. I would say what's pessimistic is that should there be a recession, there's not a whole lot that the Fed's going to be able to do about it. Given the low interest rates, you look at what some of the weapons traditionally that they had. Well, there's not a whole lot there. So I would say that would be the pessimistic side of it. And what are some of the signs that are troubling out there? And I think again these are ones that are probably talked about most. The 10-year Treasury bill rate, well, it's still pretty low. You've got low interest rates, you got low inflation, high or very low unemployment. So, but I would say probably most troubling, and again, I'm just kind of reflecting on today's news, is just what's going on with trade. And I think, right now, should this continue to escalate into truly a trade war, well, that would be troubling.
Yeah.
And obviously, we need trade. Every economy needs trade to grow the GDP. I mean, that's just kind of basic. And so if you look at just overall global trade volumes in the U.S., they're just down. I mean, they haven't been this low in years. So that I would say would be troubling. But again, the good news right now, nothing appears to be imminent. The deal market. So if you look at the deal market, if you track the vitals on this stuff, both from a volume and a value perspective, the market, it's lower this year compared to last year. But you have to put that in context. The first half of last year, or first half of 18, was a record level year. So I think 19 will again probably end up being top 5 year for sure. And so all the drivers behind it, they haven't changed. And I talked about this before. What is one of the key drivers? It's companies that are going out there and doing fairly robust portfolio reviews, which are ultimately result in spins. And I would say that it's clearly a driver of the activity. We recently just did a survey about 1,000 executives and PE funds, and their perspective is what they're expecting over the next 2 years that 84% of the respondents were going to spin something out. So clearly the spin activity and separating parts of the business, that's going to continue. So I think it's going to be a really, really strong year. And likewise, we polled our clients and we polled some other folks from the C-suite, and 52% of the folks plan to do a deal over the next year. I mean, we've been doing this survey for years. I would say generally that number probably ends up in the mid-40s. So that's really high when you look at it over the last 7 or 8 years. So at least from our chair, for what we're seeing in the market, I think it's going to be a good year for M&A, certainly going out for the next 12 months. But everything is there. The availability of credit, we talked about private credit with private equity, tons of dry powder there. You got all the dry powder sitting there with private equity. All the fundamentals are there for a good deal market.
And when we're looking, obviously none of us have a crystal ball. It's hard to predict what could be the trigger for the bubble to pop. Maybe it won't. What are you telling your clients in terms of preparing? Because maybe that's the more important question than actually predicting what the crisis, what could start it. So I'm curious, what are you telling CEOs, managers?
Yeah, so I didn't finish my talk track. So we have the optimistic view, we have the pessimistic view, and then I would refer to what I like to refer to as a realistic view. I mean, at some point this is going to happen. And so, what we have seen is companies that are pivoting to prepare for that will do quite well. If you go back to the financial crisis that happened 10 years ago, companies that had prepared in some way for that, and preparing from a lot of different aspects. And that's why I refer to that as a realistic view. Who knows? But if you're not prepared for a downturn, then you're going to have trouble. So what we see, the clients that, if there's a best practice to all this, it really kind of starts with portfolio review. What are some companies, let's just free up the capital. What are parts of our portfolio that we're not going to invest in, that's not strategic, it's not core? Let's either spin that now or get it prepared to spin, so we have that optionality. Let's take a look at our capital structure. Now is the time, obviously, to go out and renegotiate terms. Can we get additional credit lines? Is there something we can do in terms of an equity raise? Just have some dry powder sitting on the sidelines. Additionally, take a hard look at all aspects of the business. Maybe take a look at the supply chain. Look at the sourcing risks. Take a look at the customer base. Are there some vulnerabilities there? And what's really key to this, it's not all about just building the resiliency and sustainability of the business, but it's also being prepared. This is where companies that did very well in the downturn is that they were prepared to actually make strategic investments and take share. Because I think that's really the strategic side of this. It's not all about a defensive maneuver, but it's really preparing oneself or a business to be able to to take the offensive and actually make strategic investments and take share.
You talked a lot about portfolio optimization, and there's a big debate going on in terms of what is it better, to be a conglomerate, diversified, or to be focused on your areas of strength. And I think we're definitely currently in the phase where a lot of the big conglomerates are slimming down, whether it's a GE, a ThyssenKrupp, a Siemens, UTX. And I'm just curious, do you think this is just the natural cycle that we see that keeps many bankers employed, is to build up and then to sell, or do you think this is a long-term shift that really you have to either be a leader in your space or you have to get out?
I mean, at least in financial services, we always talk about sort of being 1, 2, or 3 in a market, right? So there is a scale advantage, but I think the market hasn't necessarily recently rewarded the diversified conglomerate the same way because they can't benchmark sort of performance collectively.
Right.
So I think you're right. We're sort of in a different phase around how value is perceived by the market and how value is created. But I will say that there's sort of this interesting around sort of trend, I guess, around, at least in financial services, maybe insurance specifically, around thinking differently about the vertical, right? So maybe we're not far and wide, but maybe we're integrating to sort of solve for sort of distribution issues. So I think it's maybe being a little bit more prescriptive around the business that you're in and how do I best create, strategic advantage around that business that's number 1, 2, or 3 for me. And so I think that as capital needs to be deployed to drive effectiveness, spreading it thinly is no longer sort of the right outcome potentially in a world that's fast disrupting and fast changing. So it's pick your places and pick your places to win. And sort of maybe there's the scaled, sort of dynamic around that.
Got it. And when you're talking to your clients about doing deals, how much of a concern is completion? Obviously, the regulatory risk. We've seen a number of high-profile cases where deals were almost used as political footballs, whether it was CFIUS, Qualcomm, Broadcom, et cetera, or MOFCOM in China. So how do you address that, and how can you really make the decision from the get-go it's worth taking the risk or not?
Yeah, no, I think that obviously that seems to be an issue that changes week by week. But I think, once again, the resiliency of the deal market to deal with yet another challenge, continues to impress me. Yeah. But I would say, our company is not moving forward because of a threat, whether it's CFIUS, Hart-Scott-Rodino. The answer is no. Obviously, there's diligence done with respect to that. The appropriate advisors are brought in, but in terms of not transacting because of this as a concern, we're not necessarily feeling that.
Got it. And what about in terms of, we've seen kind of, if you look back kind of your career, you look at all these deals, I always ask myself as an M&A reporter, what makes a deal work or not? If you look at Daimler's attempt to buy Chrysler, that was an absolute disaster. Fiat's purchase of Chrysler's almost saved the Italians. What did they do differently? Is it luck? Is it skill? Is it integration? I mean, how do you make a deal actually pay off?
Yeah, well, I think first and foremost, and this has never changed. This has always been the same. I mean, the key driver to doing any deal has got to be strategic. Yeah. And I would say, one of the things that I've clearly seen from a trend perspective is the fact that companies are transacting to transform. And I think this is really significant because if you think, historically, any large corporation of scale trying to make changes internally always seems to take years, and the outcome is generally 50% of what was expected in the beginning. So it's half the outcome, twice the time. And what we're seeing is that companies are using transactions as a way to rapidly transform the company. There's a lot of reasons for that. I mean, first of all, you have the market, which is incredibly impatient. The activist shareholders are not going to wait for 2-3 years for you to figure it out. But also, you look at just the supply of human capital. If you're a business, you're in the industrial space, and you want to go digital, what are you going to do? Hire 1,000 software engineers? You don't have the time to do that. It seems a lot quicker. Well, let's just transact. Let's bring those folks in. And you can see that whether it's the consumer products business with the shifting customer demands, well, you can sit there and try and do all kinds of market research and figure out which way it's going, or you can just buy the company where they're moving towards and then divest. And again, it feeds into this cycle. Likewise, you have vulnerabilities in your supply chain. It seems more and more, particularly as we talk more about these trade wars, to go more towards let's sell it locally, let's source it locally. And so these complex supply chains now, particularly with it appears to be kind of this nationalistic trend, let's transact around that. And I'd say the last point around this is that companies have gotten really good at this. Whether it's buying a company and integrating it, selling it, or separating, there's this institutional muscle memory associated with this. And we're seeing that clients have just realized that, holy cow, we're able to transform this company in about 18 months. Is there some way we can take this organizationally, this culture that we've built, this muscle memory, and somehow innovate faster, bring products to market faster? Let's not take 3, 4, 5 years. Let's make it a year. And I think that's another part that corporate America, through transactions, has really found a way, because of these compressed cycle times, to be more innovative.
Got it. And this is kind of a selfish question before I head back to London. I'm curious, what are your U.S. clients talking about when it comes to Brexit? Are they, is the U.K. a no-touch destination, or do they, are they seeing longer term that, there are a lot of U.K.-based global companies? What can I tell the companies, the CEOs back on the ground?
So the UK has always been a very favorable place for investment in capital. There's a lot of M&A activity there. I do think that it's equally a great innovation hub these days. If I look at sort of financial services, it has been a great center for the drive to open banking. And so I think there's going to continue to be sort of capital flowing into the UK, Brexit notwithstanding, simply because it's going to solve, again, for a strategic purpose around a transformation of a market, a talent equation, or frankly, a value creation opportunity with sort of the energy that's there. So there's a lot to be said about sort of the quality of the business opportunity in the UK. Brexit, I mean, it is not going to not affect financial services, but I think people have been planning for Brexit in financial services since the day it was sort of on the table. And they've been taking no regrets actions, and they have all of those plans in place to execute.
Yeah, and I'd say from a general perspective, the UK is a lot like North America. Companies are doing portfolio reviews as well. Right. And so there's a lot of really attractive targets that are being spun off.
Yeah, and it may, with some of the shifting resources, I guess, from London to the places like Paris and Frankfurt, having to take an extra trip to Paris, there's worse things in the world, I imagine, to visit your clients there. So,
exactly.
And in terms of just your outlook overall, we talked a lot about the bubbles, the risks. What is your prediction kind of for the rest of the year and going into 2020? Are you feeling kind of glass half empty, half full? What's your honest view, even though I know there's the pessimistic, realistic, and kind of more optimistic?
Yeah, I mean, I will say that I'm very optimistic about it. And again, that's based on the survey that we've taken that's been remarkably predictive. So I think we're going to see a very, very good year from an M&A perspective. Again, I think it's going to be a top 5 year. And I think, there's a lot of optimism with respect to the economy.
Great. All right. Thank you very much.
Thank you.
Thank you.